In this video, I'm going to discuss the 5 critical questions you need to ask prospective hard money lenders when shopping for a loan to finance your real estate investment. If you don't ask these questions, you could be setting yourself up for emotional stress and financial distress. If you stick around, I'll show you how to access our hard money lender analysis tool that'll make it easier for you to compare different loan options being offered when shopping for a hard money loan. This video is the follow-up to our previous video titled 2021 New Hard Money Borrowing Guidelines and the 4 Things House Flippers Need to Know to Come Out on Top. You can click here to watch either one of them or check them out later on our YouTube channel. And as always, if you enjoy our content, please share it with friends and colleagues and hit the like button below and subscribe to our channel with the notification bell turned on. Hey everyone, Evan Shweky, your Swipe Left for Success host and CEO of Delarosa Lending Group. We are a hard money lender as well as investors in multifamily, fix and flips, and commercial real estate development. Swipe Left for Success is designed to educate both real estate investors and entrepreneurs alike about what it takes to overcome challenges and use those challenges to build and run a successful business. Today, I'm back inspecting the work in progress for another one of Delarosa's rehab projects here in Philadelphia. You can follow projects we're working on along with some other fun stuff on our Instagram page at Delarosa Lending. At Delarosa Lending, the thing I love most about our business is helping our clients achieve their dreams of entrepreneurship. But to do this, we need to make sure our borrowers understand exactly how our loans work. We disclose all the relevant fees up front, including draw schedules and disbursements and interest loan calculations. To us, that's simply good business practice. While most hard money lenders are respectable and legitimate, you'd be surprised at how many lenders are not so nice. Some firms choose to hide fees behind the fine print. These are called junk fees and can be substantial, taking a big bite out of your potential profits. So let's go through each one of the 5 questions that you as a borrower need to ask a potential lender. Having the answers to these questions will give you the information you need to decide which lender you want to do business with and, more importantly, which lender to stay away from. Number 1, fees. Probably the most important question you want to ask your lender revolves around any fees associated with your loan. Fees can show up at any point in the loan process and can add up very quickly. You want to know what they are up front so you don't get caught with a cash shortfall at settlement. The following are some of the fees you should ask about. Points. So, what are points? Points are basically a percentage of the principal or total promised loan amount that the lender is going to charge you to make the loan. Each point represents 1% of that principal amount. As an example, let's assume you're borrowing $200,000 and the lender is charging you 2 points to make the loan. This means that you'll be required to pay an additional $4,000 on top of your interest payments. Points vary from lender to lender, but usually range from 2 to 5 points based on your credit worthiness and experience. 2. Understanding writing and origination fees. In addition to the points, some lenders will charge an underwriting or origination fee, which will typically add an additional $2,000 to the cost of your loan. Ask your lender if there's an origination fee with respect to your particular loan. Appraisal fees. Ask your prospective lender how much they'll be charging for an appraisal of your property. Appraisal fees can run anywhere from $400 to $1,200. Application fees. If your prospective lender charges an application fee, which can run as high as $800, ask them to waive it. Legal fees and document prep fees. The lender usually has a lawyer and their assistants reviewing and preparing loan documents. In many cases, the cost can exceed $2,000. Find out if there are inspection fees or fees associated with construction draws. And lastly, inquire as to whether the lender will be escrowing a portion of your loan for taxes, insurance, and monthly interest payments. If they do this, find out what the total amount of the escrow will be for your loan. Ask the lender if they charge a monthly escrow management fee. This can run anywhere from $200 to $500 a month. So on that $200,000 loan, you could cumulatively rack up anywhere from $9,400 to over $14,000 in fees, and you haven't even borrowed a dime. By now you get the picture. You want to know every fee associated with the loan and when you'll be required to pay it. I've had clients come to us from other lenders where the experience was not a good one. They got involved in loans that had exorbitant junk fees, but in the excitement of being approved, mentally calculating their perceived profits and thinking they're on the road to riches, they didn't review the details behind the loan. You might call that scenario a swipe left moment, one of those painful learning experiences that leads to greater success in the future. Now, this doesn't have to be one of your swipe left moments, as it's easily avoidable when your lender gives you full disclosure of all the fees that will go into making the loan. As an aside, always be wary of paying fees prior to closing. There are scammers out there who have no intention of ever making a loan when the time comes to pay those fees, and you should only wire your funds directly to a title company or an attorney's escrow account, never directly to the lender. Question 2, how does interest accrue? The second question is one that most borrowers never think about. The lender will typically disperse a portion of the loan at closing to cover a large portion of the purchase price of your property. Any remaining loan proceeds are then dispersed over time in a series of construction draws based on completion milestones set out in your scope of work. Having this information, you should ask the lender if interest accrues on the entire amount of the loan from day one, or only on amounts actually borrowed as draws are dispersed. Most borrowers assume they're only responsible for the interest that accrues on the amounts borrowed. Don't make assumptions. Get confirmation from your lender. I've come across too many horror stories of borrowers not discovering they're responsible for interest on the face amount of the loan from day one until they've actually received a payoff statement showing the accrued interest figure significantly higher than the amount they calculated in determining their cost on a project. Ask the prospective lender what percentage of their loans are in default or have been in foreclosure in the last couple of years. In all likelihood, they aren't going to answer that question. If you have an attorney, they can easily search court dockets for that information. The reason you want to know this is that if you discover they've filed an unusual number of foreclosure actions, then you have to ask yourself if the lender's interests are aligned with yours. Any reputable lender should have very few of their loans land in the courthouse. They're experts in underwriting deals, and newer real estate investors should look at a lender's loan commitment as a stamp of approval with respect to the profitability of the project. Too many foreclosure actions suggest the lender may not be doing its underwriting due diligence correctly and may be lending you money on a project you should have passed on. The lender might argue that it's the borrower's problem if they're unable to successfully complete the project. Either way, you end up a loser on the investment. At Delarosa, we've turned down loans that would have been profitable to us, but questioned whether there was enough profit in the deal to make it a worthwhile venture for the investor. Our goal is to build relationships with our borrowers and not just do one deal, but many deals. A potentially disastrous result awaits those investors dealing with a lender who's more interested in getting as much of their capital working in the market and doesn't view your success as their success. The lender, on the other hand, will make out just fine. Don't worry if you can't get the foreclosure information, since you can also get a good feel for a lender's reputation by reading online reviews and talking with other real estate investors and asking about their experience using a particular hard money lender. Question number 4. Ask your lender how they deal with construction draws. In many cases, a hard money lender requires you to use your own capital to fund the initial draw to start construction. Then the work will be inspected and you'll provide the lender with invoices and receipts, at which point you'll be reimbursed. Imagine not asking this question and you're at the settlement expecting to leave with a construction draw of $25,000 to get the first phase of the rehab project done, only to find out that you're not getting a penny from the lender toward the construction draw until the first phase is completed on your dime. If you don't ask about construction draw disbursements up front, your project may be doomed to fail before you ever get started. Question number 5. You need to know what happens if for some reason you're short on the funds needed to complete the project, or you've completed the project but it hasn't sold and the loan is maturing. What penalties will be forthcoming and how much will they be willing to assist you? Whether it's an unanticipated delay, construction issue, or market conditions that have deteriorated and the property's not selling, how your lender handles these types of situations can be the difference between you completing with a lower profit, maybe a slight loss, or losing your entire investment. So, to recap, here are the 5 critical questions you need to ask a prospective hard money lender. What is the breakdown of fees and expenses associated with the loan? How will the interest on the loan be calculated? What percentage of your lender's loans are in default? Will construction draws be advanced at closing? And what happens in the unlikely event there's a shortfall or an inability to pay off the loan at maturity? We'd like to hear from you in the comments section below. What has your experience been when applying for a hard money loan? Were you surprised at settlement to find out that you were responsible for unanticipated fees? Which of the 5 questions could have made your experience with your lender better? Your experiences could provide someone else with a swipe left advice and save their project. As promised, I'll drop the link in the description section below for access to the Delarosa Hard Money Lender Analyzer spreadsheet. The analyzer will help you accurately compare the real cost of your loan when accounting for upfront fees and expenses in addition to the advertised interest rate. And again, please consider subscribing to our YouTube channel if you already haven't done so. Thanks for tuning in. Stay tuned for upcoming episodes offering real estate investors and entrepreneurs practical advice and ideas to help you grow your business and achieve the success you envision. And we'll see you at the top.